Hi, everyone. My name is Allie Johnson, and I will be moderating today's webinar. I'll begin by introducing the Capital Pathways program, then introduce myself, and then pass the mic to our wonderful guest speaker, Ford Scott. He is a lender relations specialist based out of the Richmond, Virginia, U.S. Small Business Administration District Office. He'll introduce himself and take us through a presentation on SBA loans. As we go along, please feel free to ask questions using the Q&A function. We'll respond to them at the end of our session. For any questions that we can't respond to in this webinar, we're happy to address them through our no-cost one-on-one services or connect you with resources that can help. We will share a recording and slides of this webinar afterwards. So, what is the Capital Pathways program? It is a program funded by the U.S. Treasury SSBCI initiative, sponsored by the Virginia Department of Small Business and Supplier Diversity, and hosted by the Virginia SBDC and George Mason University. We'll start with the program overview, then go through program eligibility, and finish up with an outline of the services we offer. Capital Pathways is a no-cost, specialized SBDC program that helps small businesses help build the systems and habits needed to become capital ready. Why does capital readiness matter? Being capital ready matters because businesses that are less prepared can often self-select or fail out of loan applications. Early failures correlate to lack of adequate capital, and higher cost alternatives don't build long-term capacity. So ultimately, only about half of the loan amounts requested actually reach small businesses. To put things in perspective, about 25% of small businesses need access to financing for growth and preserving cash flow. However, only about 20 to 30% of those who apply actually get their loans approved. To help address this challenge, Capital Pathways has created a path to financial and legal readiness. Our program offers an immersive, hands-on group experience paired with one-on-one support. Who's eligible for this program? Very small businesses and nonprofits at any stage, those facing challenges accessing traditional financing. So to go over our services, we start with a self-assessment that pinpoints your business's key gaps so we can connect you with the tailored resources, either through our Capital Pathways program or through one of the other resources that can help. After our self-assessment, we move on. After our self-assessment, we move on to legal structure validation. Our in-house advisors can help you through more basic legal questions, and we also partner with a law firm which can help with more complex topics related to business registration, trademarks, and contract and agreement reviews. We also offer financial webinars on topics including financial basics, financial statement preparation, and QuickBooks training. Additionally, we offer one-on-one tailored support on business foundations, profitability and pricing, financial forecasting, financing options and readiness, financial statements and tools, and loan readiness and lender preparation. Our loan application readiness services include both webinars and one-on-one individualized support. These webinars cover topics such as what lenders look for in loan applications, interactive mock loan interviews, and sample application analyses, as well as webinars like today's session on SBA loan options. We also have a partnership with a lender who provides one-on-one support for those looking for capital. So if you're interested in getting started with this program, you can reach out to us through our website at virginiasbdc.com facebook.com/programs/capital-pathways. Or you can reach out to me directly at ajohn216@gmu.edu. I'll share my email and our website link in the chat for you all to have. I'll pass things over to Ford to introduce himself, tell us a bit about his background, and start his presentation.
So my name, as Allie mentioned, is Ford Scott. I'm what they call a lender relations specialist with the SBA. We for years called ourselves the Richmond District Office. I think we switched to Virginia. We do cover all of Virginia except Northern Virginia, the counties of Arlington, Fairfax, and Loudoun. But I will say that all the information on our lending programs that I'll present today are the same nationwide, so you don't have to worry about different parameters for Northern Virginia. So I'm going to outline for you. We have three main lending programs. You will get a copy of the slide deck. Allie, I think there was a question in the chat about Chat GPT or something. I don't know if I can't answer that, but okay. So SBA does not offer grants of any kind to small businesses, either to start or grow their businesses. We just don't do that. We do not lend directly to small businesses except under our disaster lending program. So that is only when, there's a tornado, an earthquake, a flood, something like that. Our disaster lending program will lend to small businesses directly. So generally, most of our lending is done as a guarantor. So lenders make the loans to you, commercial lenders. We have some small business lending companies that we work with. They actually lend the money to you, and we provide a guarantee, which means that if the business defaults, we will reimburse the lender for a portion of their loss. And that's our way to encourage lenders to lend to small businesses. The guarantee can help offset some situations that lenders are generally not comfortable with, such as startups, insufficient collateral. In fact, insufficient collateral is probably the main reason that lenders use our program. If there might be some non-standard repayment terms and industries that the lender is not comfortable with. So our guarantee helps mitigate some of that risk for the lender and encourages them to lend to those businesses. I did want to cover first some ineligible types of businesses and uses of proceeds. So we cannot, in none of our lending programs, except our disaster lending program, but all the programs I'm going to talk about today cannot be used by nonprofits, unfortunately. We also, the second bullet here comes up frequently, we also cannot finance investment properties. So if you're going to buy a property or construct a building and then you're going to rent it out, let's say apartments, mobile home parks, shopping centers. We get calls from people that want to buy houses, fix them up, and then rent them out. All of that is ineligible. So what we require, if you're going to buy or construct a building under our lending programs, we require that you occupy at least 51% if you're buying an existing building. And then if you're going to construct a new building, it has to start at 60%. We can lend for residential facilities that are licensed as nursing homes or assisted living facilities, as long as they provide services, medical and healthcare services beyond room and board. So we're getting away from the apartment building format. We also can't lend for pyramid or multi-level sales distribution plans. The old example of that used to be Amway. Any activity that is illegal on any level, federal, state, or local, is ineligible. So the main reason that that's there is because marijuana is legal in some states, but federally it's still illegal. So you can't have a business that's selling anything related to marijuana. Although we do allow lending to hemp and CBD, as long as it doesn't reach that level, that THC level, and there may be some additional background information that would have to be provided. We also can't lend to a business that restricts patronage for any reason other than capacity. So for example, if you had a men's only or women's only health club, those are ineligible for SBA financing unless they're open to everyone and they provide both a men's and women's changing room restroom. This last bullet here, we did change our policy related to past criminal history. We just have one question now on our application that asks about this. So if you're an owner of the business, at least 20% or more, if you're currently incarcerated, that makes you ineligible. If you're serving a sentence of imprisonment imposed upon adjudication of guilty, or you're under indictment for a felony or any crime involving or relating to financial misconduct, then you're ineligible. But if you can answer that question no, meaning none of that applies, then you would be eligible. The last item here, so if you had a federal loan in the past and you defaulted on that, and the balance was charged off, meaning you didn't pay the loan in full, you cannot get a new SBA loan until that balance is paid off. So if you have a delinquent federal debt currently, or you had a charge off of a federal debt in the past, then again, you would have to pay that balance or bring the loan current in order to apply for a new loan. And then our policy has been tightened up related to lending to businesses, related to citizenship, et cetera. So our loans can only be used by U.S. citizens, U.S. nationals, and what they call lawful permanent residents. If you happen to fall into that last category, there will be a process where you have to provide a copy of your green card and then fill out with the lender a form, and we send that over to the USCIS and confirm that you're in the country legally. So now I'm going to talk about the three main lending programs we have. The first one is called the 7A Loan Program. It accounts for probably 90% or more of our lending. It has a broad it's broad in terms of the proceeds that you can use it for. So I've already mentioned acquiring, refinancing, or improving real estate and buildings. You can get short or long-term working capital. You can refinance current debt. There are some additional considerations there that you would discuss with the lender. Basically, what we're looking for there is that the refinancing provides some benefit to you as the business owner, or as the business. So in other words, let's say you have a current debt and the interest rate is very high, or the term that was granted by the lender was not appropriate. So let's say you bought a piece of equipment that had a useful life of at least 10 years and the lender only provided a loan for maybe 2 years, you could potentially refinance that. You can purchase and install machinery and equipment. You can buy furniture and fixture supplies. We do allow financing of changes of ownership. So that could be, somebody coming from the outside buying a business, or you could have what they call a partner buyout, where one owner is buying out another owner. Those are eligible. And in fact, we changed our policy recently to also allow partial changes of ownership. So let's say you had a business that's currently owned 50-50 by two people, you could buy in for only 50% of that business. There are additional requirements related to that. Again, the lender would outline that for you. We do lend for franchise operations. This is not your responsibility, but SBA does publish on its website an SBA franchise directory, which lists eligible franchises. The lender will be responsible for checking that, and if it's not on the list, then the franchisor would be required to submit the information to SBA for review. But again, none of that is your responsibility. The lender and/or the franchisor will take care of that. You can have multiple purposes for your loan. They can either be combined into one loan, or you could, for instance, have one loan if you're going to buy a building. That would be a term loan. And then you could also get a line of credit if you needed a line of credit. But that would be discussed with the lender and worked out with the lender. For this program, the maximum loan amount is $5 million. I've covered some of the eligibility factors on the previous slide. The lender will look at your credit history, and we're going to cover that in a minute, and look at the additional information, which I'm going to cover in a minute. We do have what is called an SBA Express Loan Program. And again, I don't want to flood you with details. The only reason I mentioned that is that you can get lines of credit under that program up to 500,000. And that's generally the best program to use if you're seeking a line of credit in that loan amount. I will send out, or Allie will, an SBA loan chart that outlines all of these programs that I'm discussing, and it will give you general parameters of each. We're going to talk about how SBA sets maximums for its interest rate and maturity, and that's all going to be outlined on the chart. The second program I want to talk about is our 504 loan program. This has a limited use in terms of what can be financed. So you can either buy or construct, again, owner occupied, no investment properties here either, commercial real estate. So you can buy an existing building or construct a new building. You can also use it for long-term machinery and equipment. So that equipment has to have a useful life of at least 10 years. And it's equipment that's put in place and stays in place. The old example used to be a printing press. So a printing press generally is installed. It doesn't move around. You can't finance trucks under this program. Generally, anything that moves around, it's installed and stays in one place. The benefit to you of this program, so first of all, you see in the first bullet there, this program is handled by SBA approved, what they call certified development companies. They are nonprofit partners who promote economic development within their communities. So you would work with them. They would actually ask you for the documentation, and then you would return it to them. They're all certified and regulated by SBA, and there are 3 in Virginia. You'll see when you click on that link. And they all lend anywhere in Virginia. So they all would be happy to talk to you about a request anywhere in Virginia. The maximum, the way they also call this program the 50-40-10 program. And the reason they do that is a lender will generally provide you 50% of the financing you need under this program. SBA will generally come in for 40%. And then you are required at a minimum to inject 10% of the total financing that's needed. So on our portion, that 40% that we finance, our maximum is 5.5 million, but there is no maximum what we call project size. It's just that our piece is limited. And the benefits to you as a small business owner of this program are that on our 40% financing that we provide, for commercial real estate, we can provide you a 25-year maturity, and the interest rate that is charged is generally lower than what you would get if you went and applied for a conventional loan. So you have a lower interest rate, you've got a long term, you will know what your payments are for that full maturity. You can also, under this program, finance out-of-pocket costs that would normally have to be paid at closing, and that can be a substantial amount. So you can finance those into the project as well. And you'll see there the last bullet, the 504 program, as I mentioned, cannot be used for working capital inventory, things like that, but you can combine a 504 and a 7A together. And we see that frequently when someone's buying a business. So they will finance the real estate through the 504 program and then finance the actual change of ownership through the 7A program. And then the other thing that we see on a regular basis is a 504 for the real estate again, and then a 7A express. I mentioned the express line of credit, so you could get a companion line of credit with that 504. The last program I want to mention is our microloan program. I will say that in Virginia, and when you click on this link, you'll see this. Each microlender is approved only to lend in a certain territory. So you will have to check based on where your business is located to see if there is a microlender covering your area. We have some holes in the state. In the Richmond area, we don't have a microlender, and then in the Hampton Roads area, we don't currently have a microlender, but we've got one in Stanton, we've got one in Abingdon, and we've got one in Charlottesville, and then there's one that covers Northern Virginia. So just keep that in mind. You can click on that link and look and see the territories. But this program works a little different than what I explained for the previous two. So we lend money directly to nonprofit intermediaries. They actually lend the money, then turn around and lend the money to you. They can make loans up to $50,000. This is the one case where you'll see they can, I believe, lend for not nonprofit child care centers. That's the only exemption there, and only under this program. But you apply directly through them. The loans can be used for working capital inventory, supplies, furniture and fixture, machine or equipment. You'll see there it cannot be used to purchase real estate. And then if you're going to, it can accommodate refinancing of existing debt, but only if it improves your debt position or cash flow of the business. So what to do before approaching a lender? So Allie made a good point in her lead up. The less prepared you are, you sort of self-select out of receiving the financing that you need. So a lot of the approval will depend on how well you present yourself, your business, and your financial needs to the lender. The best way to improve your chances are to either prepare a loan proposal or a business plan. The SBDC can definitely help you with both of those. If you want to think about the difference between a loan proposal and a business plan, the loan proposal is going to be more a focused document specifically tied to trying to obtain financing, whereas your business plan is the overarching document for your plans for your whole business, and it would entail more than just the loan proposal. I have a presentation which I'll send to Allie that I've done a webinar on this several times, and I'll send a copy of that. She can send that out to you. But it's your choice which one. I will say in terms of the business plan, you probably heard this if you talk to the SBDC, that the lender doesn't want to see a 100-page business plan anyway, even if you're not doing a loan proposal. They want a more streamlined document to look at. So the lender is going to look for evidence of strong management, experience in the industry, an understanding of the marketplace. And probably the most important thing, I probably should have put it in red here, is that they're looking at the financial information, because the most important thing in their mind is how you're going to repay the loan. So you see there at the bottom, before you approach a lender, you should have basically 4 things in mind. How much money you need. So what I usually say related to that is small business financing is not like mortgage lending or auto financing, where you go to that lender and you say, how much do I qualify for? That's not the way small business lending works. You need to come to the table with the dollar amount that you're requesting. I would not recommend ever going to a lender and saying, how much can I get? That will leave a bad impression in the lender's mind. So you come to the table, you give them the dollar amount. Now that may be, they may have some advice for you, say, well, maybe you don't need so much here or there, but at least initially you have to come to the table with a dollar amount. And then you'll outline the second bullet there, how the money will be used. So you will give a breakdown, let's say 50,000 for working capital. If you're going to buy equipment or supplies, you should have an estimate, definitely an estimate of that, and give some comfort to the lender that you have investigated what that will actually cost. When you've included that in your list of loan proceeds. The third bullet there, how you will repay the loan. Of course, I already said it's very important to the lender. And then the last one there is what you will do if your business is unable to repay the loan. So in that case, they're looking at collateral that you would have available to offer to back up the loan. We'll cover more on that in a minute. So with credit report, we get questions a lot on, will the lender pull my personal credit report? I've never heard of a lender that will not do that. In other words, they will. For every 20% or more owner, I think almost 100% of them would pull your personal credit report. You'll see there for personal credit history, there are 3 main credit bureaus. You may already probably know this: Equifax, Experian, and TransUnion. I would recommend that before you even start your loan request, that you check your credit history. make sure it's accurate and clear up any errors. I remember reading an article that up to 25% of credit reports have some sort of error on them, so it's worth checking. That next bullet there, and I actually do this myself. In fact, I just did it in December. Every year you can get a free copy of your personal credit report at this website. Now, there may be other websites where they want you to pay for this, but this is the only authorized source for the free credit report. So you can get it from all three agencies, Equifax, Experian, and TransUnion. And then it won't give you your score. If you want the score, you'll have to pay for the score, but it will at least let you see what is on the credit report, and you can clear up errors. If you need help in repairing your credit history, you could contact a local credit counseling service. I thought I put it in here, but I guess I didn't. We don't have a list of those services, but the State Corporation Commission does have a list on their website. But I will say, even, if you're looking at that list, it's still you're up to you to do your due diligence to make sure that you're working with a reputable credit counseling service. But you can, again, the Virginia State Corporation Commission has a list of those credit counseling services. And then for commercial credit reporting agencies, not all lenders will pull commercial credit reports, but some will. The three entities that provide them are Dun & Bradstreet, Experian, and Equifax. The links here, I tried to make these links go to the place where you can, a lot of them will let you see what they already have listed for your business, or if they have anything. But you'll see my note at the bottom. They do have other services that they may charge you for, so be careful. We're not advising you to enter into that. That's your choice as a business owner. But you should be able to at least see what they have on your report. I don't know, Allie, I'm conducting a webinar on February 5th on how to establish business credit. So I don't know, maybe Allie, I could send that to you and you could send it out to them if that's okay.
Yeah, absolutely.
So we covered some of this. So what a lender will look for when they're reviewing your application, they're looking for owners and operators of good character. The main way, I've just covered this on the previous slide, they will look at your past credit history to determine whether you've been willing to meet your financial obligations. And we also covered our one question about criminal history. We talked about a feasible business plan, so the SBDC definitely can help you with that. Also, the SBA website has substantial information and some templates, I believe, on how to write a business plan. And I'll send you also that loan proposal outline I mentioned. Management expertise and commitment necessary for success. So they will be looking at your past experience in the industry that you're in. If you're a startup, they want to see, have you ever run a business before, or do you have any experience in that industry? Now, if you're going to hire a manager, that's okay. But you should outline what that hired manager's experience is. If you're not going to be there full time, day in and day out, and a hired manager is, you need to give them some comfort level that person has some expertise and commitment. Sufficient funds, including the SBA loan to operate the business on a sound financial basis. So we're going to cover in a few minutes the financial information that the lender will want to see. Adequate equity invested in the business. I don't believe I have this in the slide deck, but SBA has only we have a minimum for startups under the 7A program, which is 10%. So we require the lender to require at least a 10% equity injection on our 7A lending programs. And see, here's where it gets to be too complicated for you to worry about. But under the Express program, we let the lender set the equity. And overall, in terms of cash equity that they'll ask you to inject, each lender is going to have their own criteria anyway. So even though we set a minimum of 10% for a startup, the lender may want to see more than that. Of course, if we encourage them to use our criteria if they're using our lending programs. But again, the lender is permitted to set that equity injection. Sufficient collateral. So I mentioned to you earlier, probably the primary reason that lenders use our programs is there's a shortfall in collateral, and we're fine with that as long as repayment ability is shown. But we do have certain policies, and the lender will have to follow that. So just as an example, when you get to SBA loans over 500,000, SBA will, I'm sorry, over 350. It used to be 500, it's now 350. We will require, if you own a home and there's at least 25% equity in it, we will require that as collateral if the loan is not fully secured by the business collateral. And then the last bullet there, which is in red, I've said this before, but the ability to repay the loan on time is very important to the lenders. They will either look at historical information. If you're a startup, they will want to see projections that indicate that you can repay the loan. Some common questions about applying for an SBA loan. Do you apply directly through SBA? The answer is no. You always apply directly through a lender. We do not accept any loan applications here or do any kind of pre-qualification screening here. You would just find a lender. They would ask you to provide documentation and you would give that back to the lender. In terms of the paperwork, this slide deck is designed to give you an outline of what a lender will ask for related to an SBA loan, but we can't cover everything. Each application is different, so it may differ slightly based on your specific request. So now we're going to cover the documentation that's normally required under the 7A program. So this is an outline of what SBA requires. There may be some additional information that the lender wants to see from you that they would normally ask for under their non-SBA loans. But every 7A, including Express application, there is a borrower information form, which is basically the application form. And you're welcome to look at that at this link when you get the slide deck. It's completed on behalf of the business itself. So every owner does not have to fill out this form, just the business fills out the form. And then one person who is certified or is authorized to sign the form would sign the form. Every lender is going to ask you for a personal financial statement, and that would be required for anyone who owns at least 20% or more of the applicant business. If there happen to be additional guarantors, they would also be required to provide the statement. And we require that that statement be no older than 120 days at the time it's submitted to SBA. And the statement does have to include the assets and liabilities, all the information from if the person is married, it has to include the assets, liabilities, all the information for that person and their spouse and their minor children. If you wanted to get an idea of what will be asked for on that form, I've given you a link to the SBA form, which is the form 413, but the lender is allowed to use their own equivalent form. So it may look slightly different, but at least that'll give you an idea of what would be asked for. If the lender is charging a fee, and this would be a non-SBA fee of greater than $2,500, they may charge you what they call a packaging fee because they're helping you with your application and your business plan, etc. There's an additional form that has to be filled. It's not complicated. It's just a form that has to be filled out. And the lender is required, the last bullet here, to obtain federal business income tax transcripts from the IRS for the last 3 years, or how if you've only been open for a year, they'll just get 1 year, or 2 years, they'll get for 2 years. But the purpose of this is twofold. One, to make sure the business is small, and then and that's why this is in yellow here, to make sure that the financial information that you are giving to the lender matches what was given to the IRS. And we did see during the pandemic, we had small businesses applying for pandemic-related loans, and they would submit information to us. We did this. We checked the business income tax transcripts with the IRS, and the data didn't match. So that's considered fraud, or it's not going to look not going to help you. So this is a way to ensure that that information is the same. In addition, the lender will ask to see business financial statements for the last 3 years. If you have your actual tax return, business tax returns, that can be supplied instead of this, or in addition to the financial statements. If you're a startup, a monthly cash flow projection for at least the first year or until there's positive cash flow will be asked for. We Again, this is probably too many details, but just in case this comes up, we do have one lending program. It's called the Small 7A program, and you'll see on your chart the outline of that. Those are credit scored by SBA in our online system. It's a combined commercial and consumer score. The score isn't really going to be that meaningful to you. It's 165, but if you think of all of the scores, generally it's not going to be at the bottom range, the bottom range. It's not going to be in the top range because most entities that have and individuals that have high credit scores, they can get financing elsewhere. So it's sort of in the middle range of scores if you want to think about the scores. The lender will ask you for evidence of licenses and formation documents required to operate the business. So, for example, a business license, articles of incorporation, partnership agreements, etc. They'll want to see a description and history of the business, and we've talked some about this already. They'll want to know the nature of the business, what industry you're in, the length of time that it's been under your management experience, again, in the industry that for the business that's applying, or like I said before, if you've run a business before, that could help you. You could say, well, I don't have specific industry experience, but I've run someone else's business. That would be helpful. And then, as I mentioned before, a description of the business's management team, including your involvement. If you're the primary owner, they want to know your involvement. And then if you're going to have a hired manager, we already discussed that. You could talk about their lending experience. And if this is already in your loan proposal or business plan, you don't have to write up a separate document. You can just provide that proposal or business plan. So I've already mentioned this. For existing businesses, you'll be required to provide the 3 years worth most recent historical financial information. I don't think I mentioned this yet. In addition to that, if it's past, if you're past the end of the year, the lender would need an interim statement. So let's say it's June of 2026, the lender is going to need an interim financial statement in addition to the last 3 fiscal year ends. And if the historical cash flow from those financial statements does not show sufficient debt service coverage, meaning that you could repay the loan based on your cash flow, you will be required to provide additional projections and the assumptions to indicate how you will meet the repayment terms. I already mentioned for new businesses, you'll need a detailed projections, including supporting assumptions, which reflect positive cash flow within 2 years. And there's a template here. This is from one of our other partners, SCORE. They have a template that can help you with preparing your projections. But again, the SBDC, as Ali said, is there to help you if you need help with that. Equity injection. So we discussed this. Generally, especially if you're a startup, the lender is definitely going to require some sort of equity injection. If you're an existing business, that may not be required, although it could, and you'll have to discuss with the lender what their minimum is. If you're an existing business, a current debt schedule, and that would be a schedule of your debts that are outstanding for the business. You would have to outline those on a document. And that, I think I have somewhere, I can pull this out. What the lender is looking for on that is, who the creditor is, what the original loan amount was, what the current outstanding balance is, what the maturity is, the interest rate. I think that should be enough, but I will, if I can pull that out and send that to Ali, could send that out to you. If you're going to refinance debt, you would have to provide a copy of the promissory note and a payment schedule. And SBA requires that the loan is currently current and has been current for at least the last 12 months or the life of the loan, whichever is less. And you'll see their current means that the payment has not remained unpaid for more than 29 days. If you're renting space, the lender will want to see a copy of the lease. And generally, SBA's policy is that in terms of a lease, that the term of that lease, including options to renew, be at least equal to the loan maturity. So let's say the lender offers you a 10-year loan maturity. They are going to want to see on that lease that the term of that lease, including options to renew, is at least 10 years. The lender will talk to you about that. I'm just mentioning it for your information. We talked about franchises. So if you're a franchisee, you will be required to give to the lender a copy of the franchise agreement, the franchise disclosure document, which is usually, it can be 1,000 pages. In some cases, it outlines all the information you need. It's provided by the franchisor. And then any other documents that the franchisor requires you to sign, you would provide that to the lender. You would outline for the lender any federal, state, or local citations which might preclude the business from normal business operations. You would also discuss any liens, judgments, bankruptcy filings, or pending litigation involving divorce proceedings. I'll say a couple of things on that. SBA has no hard and fast rule related to bankruptcy. So if you had a bankruptcy in the past, it's not a definite decline. What the lender is going to want to see in that case is that you have reestablished credit, and that you have a payment history after that bankruptcy filing to indicate that you've reestablished credit. The second item there I'll mention related to divorce proceedings. So if you happen to be in the middle of a divorce and it hasn't been finalized, to outline the breakdown of the assets, that your application is not likely to move forward because especially for larger loans, because let's say there's a house involved and you don't know who's going to end up with that property. The lender would need to know that information when they're making their credit decision. So the best policy is to, if you can, have that divorce proceeding finalized before you apply for the loan. As I mentioned earlier, if you're buying equipment, inventory, or other assets, a detailed listing of what will be purchased and cost quotes would be asked for. In terms of collateral, you would outline all of the business collateral and then any personally held collateral. And again, that personally held collateral is likely to come up more often for larger loans because, like I said, we will look at that as potential collateral. If you happen to be buying an existing business, the lender will ask to see a copy of the buy-sell agreement. The second item here is not for you to worry about. It's just an FYI for you. SBA requires the lender to obtain a business valuation, or either to prepare it themselves or obtain it from an independent third party. I'm only letting you know that because there will be a cost, potentially could be a cost involved in that, which the lender will ask you to pay. So, but you're not required to obtain that business valuation. In fact, if you obtain your own valuation, unfortunately, the lender is not permitted to use your valuation. They have to order the valuation themselves and have it addressed to them. A pro forma balance sheet will be asked for the business being purchased as of the date of the transfer, which would show the assets and liabilities. Copies of the seller's financial statements. So the seller will have to provide the last 3 years worth of financial statements, and then a interim statement that's no older than 120 days. And then you'll see that note there. SBA, when we're looking at changes of ownership, we want to see that there's some benefit to the business as a result of the change of ownership. So for instance, let's say you have someone who's run a business for 30 years. They want to retire, and if they didn't sell the business, they would shut it down. So we look at that as preserving the existence of a small business, and there's definitely a benefit, of course, to the small business to have that change happen. Another example might be, let's say you have you want to buy a business, and the owner is an absentee owner. They don't spend much time in the business. They have a hired manager, and the manager sort of run the business down, and you have plans to build that back up. That might be another example. But what I'm getting at is not just SBA is looking for something beyond just a willing buyer and willing seller. If you happen to be buying real estate, You'll need to provide a copy of the signed purchase agreement. And then again, this is just an FYI for you. It's not your responsibility, but the lender is required to perform an environmental investigation on any commercial property securing the loan. So there may be a cost to that. For instance, if you buy a property that is currently or previously was used as a gas station, maybe a gas station convenience store, the lender has to order what is called a phase one environmental report, and there's going to be a cost for that. So that cost will be passed on to you, but it's not going to come up with in every case, but that's just an FYI for you. So a note regarding loan closing costs. So the lender is permitted to collect from you, and this would be similar to a non-SBA business loan. Necessary out-of-pocket expenses such as filing or recording fees, photocopying, delivery charges. Definitely, we talked about collateral appraisals, environmental investigation reports, etc. So they can pass it on to you. You could ask them to finance that into the loan and see if they're willing to do that. And then, well, we talked about the business valuation cost, and then if the loan involves commercial real estate, the lender will, well, depend on the request, but they are likely to require an appraisal, and that cost will be passed on to you. SBA does have a requirement that every owner of at least 20% of the small business applicant personally guarantee the loan. You also are, if they own less than 20% and you want to offer them as a guarantor, that's fine. There are some cases where SBA also may require a personal guarantee if they own less than 20%. So you'll see there, the example they give is if they have minority ownership or no ownership, but they're critical to the operation of the business, they may be required to personally guarantee. You can view SBA's guarantee form. I've given you the link here. SBA permits the lender to use either our form or their form, but the basic concept will be the same, so you can read that and understand what's involved in the personal guarantee. And then I have given you, I hope I'm not going to get myself into trouble. This is not an SBA website, but there's this link here to an article on Investopedia, which talks about what a personal guarantee is and more information on that. So that is the end of the 7A application documentation. For the 504 program, the I mentioned the Certified Development Company, they will be the ones that you deal with. They will outline all of this for you, but if you wanted to look ahead of time, I've given you the link to the form that they fill out. Actually, you fill out pages 1 through 4 of that form, and then you'll see down here the exhibits. I've outlined the exhibits 3, 5, 6, 7, 8, etc. that they would ask you for. So that, again, they will outline that for you, but if you wanted to look ahead of time to see what they'll ask you for, that will give you that information. A lot of it is similar to what I've covered on the 7A side, so you can look at that. And then in terms of the microloan program, each microlender will have their own outline for you, so they will provide that to you. You should contact them directly. At a minimum, they will have you fill out an application, and then again provide a list of what they want to see from you. And I've already given you the list of microlenders, but there's the link again for that. So we have been asking lenders for several years if they had any advice for small businesses related to applying for a loan. And we've got 2 of them here that came up, over and over again from different lenders. So in terms of the projections, what they often see with the projections are that they're overly optimistic. So you'll hear sometimes the phrase pie in the sky. So you want to make sure, and this is where the SBDC again can help you with this, make sure that they are realistic and attainable, and also you should be able to outline what assumptions you've made when preparing those projections. And if those assumptions don't seem reasonable, the lender will ask questions about it, and you should be prepared to answer. And you'll see there the second bullet, most lenders will use industry data for instance, from the RMA, Management Association, to determine if your gross and net profit margins and other financial metrics are in line with industry averages. So those are compiled data for different industries that give them that information. And if you want to see definitions of those terms, I've given you a link here that you can look at, or you can ask Allie and the SBDC can help you with that. The second item here came up frequently again, related to incomplete applications. So if a lender, you go to the lender, you say, I want to apply for a loan, they give you an outline of what's required, you send back the information, and then they come back to you and say, well, we need some more information. And let's say they give you a list of 5 items. What they tell us is the small business will send back 2 of the 5 and expect the lender to move that application forward. Well, unfortunately, the lender cannot do that. The application will just sit there and they'll move on to a complete application and move that forward. So you want to make sure if they give you a list that you gather all of that and then provide it together back to the lender. Believe it or not, I mean, the government gets a bad rap. Most of the delay, even with SBA lending, is the back and forth between the small business and the lender, not SBA's turnaround. Here on the screen, you'll have this link. We maintain a list of Virginia SBA lenders. So this first list is the 7A and SBA Express lender list. You'll see that we keep that up to date. It's posted on our website. You're welcome to use that. And then in addition to that, there is a system called Lender Match. The benefit of using this in addition to the list I just showed you is that this potentially could put you in touch with some lenders that are not in your immediate area. So it could be somewhere else in the state, or even we have a lot of out-of-state lenders that make SBA loans in Virginia. So this could put you in touch with them. The way this works is you go to this website, you do have to create a user ID and password, unfortunately, but that's to help protect your information. So you log in, you fill out a questionnaire about your business and the financing that you need, and then that gets sent out to any lender who has opted in for your business location. If they are interested in speaking with you about your loan request, then they will opt in, and then ultimately you will get a list of any lender who's opted in, and then it's your choice which one you want to interact with. I will say, and you'll see this on the slide, one caveat about this: every lender that's on that lender match system is an SBA lender. So that system itself is not going to, send you all sorts of non-SBA options. But unfortunately, what some of the lenders do is they have relationships, with other entities, so non-SBA lenders, and they potentially might refer you over to those other lenders. And once you get outside of the SBA framework, we of course can't control things like the maximum interest rate, the maturity, and other parameters. So just be clear, if you're contacted by someone through this lender match and they, for instance, quote you a loan interest rate of, let's say, 30%, well, you're never going to see that with an SBA loan. We do not permit that. You'll see when you get the loan chart, we set maximums. So it's your due diligence again. It's your choice whether you want to enter into those non-SBA options, but just understand that once you get outside the SBA arena, we can't control any of that, and we're not encouraging that, but it does sometimes happen. One other thing that may help you is we publish on a monthly basis. It actually may be weekly now, but at least monthly, what they call SBA lending reports. And the way this can help you is the link that's here goes to our district. And I told you we cover all of Virginia except Northern Virginia. And what this will do to help you is it lists every lender who's made at least one SBA loan in the current fiscal year, up to that date. And then it goes back, I think, 7 fiscal years. So that can give you an idea of which lenders are most active in your territory. if you happen to be in the Washington, D.C. area, Northern Virginia, I've given you the link there. And then you can also, I don't know if there probably is no one out of state, but you can even look at other states to see that activity in other states. The other way it can help you is on that same report, on those same reports, over to the right, there's an average dollar size, and that can help you identify lenders that are lending in your needed dollar range. So that can help you as well. It will not give you, by the way, any contacts for those lenders, but I've already given you our link to our list and the lender match. This is just data. So we're to the questions. There's my contact information. You're welcome to contact me if you have any questions about our lending programs. And we'll see, Allie, if there are any questions.
Thank you, Ford. I'm going to ask that we both turn our cameras on so folks can see us.
Yeah, okay, let me do that. Should I stop sharing, I guess? Stop sharing?
If you'd like to, yeah. Alrighty, so our first question is if a person can use SBA loans to build a preschool.
Yeah, so as long as that preschool is a for-profit entity, that would be for our 7A and 504. And then, as I said, under a microloan, in fact, I'm going to check that right now. I believe you can do a nonprofit under a microloan, but for our 7A and 504, as long as it's a for-profit preschool, that would be eligible.
Wonderful. And I think that also addresses our next question, which was about a nonprofit who's gotten a good bit of assistance through local SBDA, but would not be eligible, or confirming that they would not be eligible to pursue or apply for any of the SBA loans that we discussed today.
So I've just said, so they're definitely not, a nonprofit is not eligible under 7A, Express, 504, but I'm checking right now for the microloan.
While you're checking, would you like the next question?
Sure.
All right.
Okay, here it is. It says, and this is in the document that the lender has to use. So it says, any nonprofit business is ineligible unless it's a nonprofit child care center. So a nonprofit child care center is eligible under the microloan program only, not 7A, 504, Express, any of those, but under the microloan program, but all other programs, no.
Good to know. So the next question is, can an applicant refinance equipment under commercial capital?
So you can refinance equipment. I think I may have covered this. So the main consideration when an SBA loan is used for refinancing is that we want to see a benefit to the small business. So again, if that equipment loan has a high interest rate, again, maybe the maturity was not appropriate for the equipment because it had a longer useful life. Definitely if it has a demand or balloon feature, SBA does not permit those. So those would be examples, but it's refinancing equipment is definitely allowed under our lending programs.
Wonderful. Next question is, could you please explain more about franchise loans, as there's no history and business plan? Is it just the item 19 from the franchisor? How to qualify for that? And are there any strict rules?
So the main thing for SBA related to franchises, I mentioned that we have the directory, and that's where SBA makes sure that that franchise doesn't violate any of our eligibility criteria and is also not affiliated with a large business because we can't lend to large business. So again, the lender will be responsible for checking that directory to be sure that the franchise that you're dealing with is on that directory. Again, if it's not, the franchisor is permitted to send in the documentation to SBA and have it reviewed, and then if it's deemed acceptable, then it will be listed there. Now, I have to say, I don't want to give you the impression all SBA is checking for when it's looking at those documents is to be sure it doesn't violate an SBA policy. It's not looking at vetting that franchise in any way. That's up to you to determine. And then I think the person was asking for, when you're applying for a loan, if you're a startup franchise, uh, the lender's going to look for projections. Now, the franchisor may provide some information that's helpful with that, but you also need to look at where that franchise is going to be located and do your own assessment. But the lender will look for projections to show that you can operate the business profitably and repay the loan. So adding the franchise component, it's similar to any startup. The lender is going to want to see projections. And we talked about the projections and the assumptions and things like that. So just adding the franchise. Yeah.
Following up on that franchise question, would a robust training plan cover the management experience requirement?
A robust training plan. I'm not sure. Well, what they're looking for on that is, again, either the owners of that business, their past experience in that specific industry, or maybe running a business for someone else. So they're just looking for management experience. Now, I wonder if they're asking that because the franchisor, will provide some training for you. So that will help. That definitely helps. But you'll still need to provide, the overview of your expertise and experience. And you can include that training that the franchisor is providing.
Wonderful. So next question is, are startups eligible for the express loan?
So startups are eligible under all of our lending programs. SBA does not prohibit lending to startups in any way. I will tell you, and you probably got this idea from what I mentioned in the webinar so far, SBA sets its policy. As long as the lender doesn't violate our policy, they can use our lending programs. But I already talked about the equity injection, and you'll see this also with startups. You'll see this with certain industries. Each lender will still set their own criteria. So, for instance, some lenders will not lend at all to startups, despite the fact that they could use our programs and make the loan. So you will just need to communicate with each lender to determine whether they're willing to lend to startups. Some of them will not lend for certain industries. A lot of lenders generally don't like startup restaurants because they generally have a high failure rate. So that might be another industry that we hear from business or people that either are in or want to start a trucking business. Unfortunately, that's also another area where you won't see a high appetite for that lending to trucking businesses. At least we don't see that here. But there again, the lender will set that. They have their own policy. You can have a discussion with them and say, well, you can apply for the SBA guarantee and that helps mitigate their risk, but it's ultimately their decision.
What about service-based startups like a coaching and consulting firm, where the primary investment is space, marketing, and working capital?
Yes, all of that would be eligible. Definitely, you can use our programs for service type industries, and everything they said is eligible.
Wonderful. Thank you. All right. So the next question is, do the costs of packaging by lenders vary, or does SBA have a rule of cost and fixed interest rate?
Okay, so I mentioned that, and I can actually pull this up now. I mentioned that we're going to send you the loan chart, and on that chart you will see, and every lender has to abide by the chart. The main program I'm talking about right now is a 7A lending program. So you will see on that chart, SBA sets maximum interest rates and the lender is not permitted to go over that. And each, that applies to every lender. So you can't have one lender that decides to go over that and another one that stays within it. All lenders have to abide by that. In terms of the cost, most, loan closing costs and things like that will be similar when you go from lender to lender. So I don't think that varies a lot. But in terms of the interest rate, also, so we set maximums. The lender, again, is permitted to set the rate based on your specific situation. We talked about credit score. So, if you have a higher credit score, you're likely to get a better interest rate potentially. But the lender, as long as they don't go over the maximum, they can set their own rate. So you might find, and lenders know that small businesses do this. They shop around. So you might go to one lender, they'll say, well, I'll make you a loan prime plus 1%. And then you go down the street and the lender says, well, I may do it prime plus a 0.5%. It'll just depend on the lender. But again, we set maximums. And I'm trying to find my document here. You can keep going, Allie, while I'm pulling up this chart if you like.
Alrighty. So our next score kind of ties on to that, next question rather, asking about lowest credit score to get loans and average credit scores that borrowers should expect to have to receive loan approval.
Okay, so again, SBA only has one program where we set a minimum score, and I explained that, and the score isn't really going to be that helpful, as I mentioned. It's sort of the middle range of scores. But again, this is another situation where the lender will have their own minimum score. Some of them, especially like our micro lenders, will allow lower credit scores. I mean, we hear from lenders, maybe their minimum score is 620, some 650. It will just depend on the lender. But again, SBA only sets that one minimum score. And that, in fact, is a combined personal and commercial score, business score. So it's not going to be useful to you. But again, that would be the middle range of scores. But each lender will have their own minimum, and you will have to check with that lender to see what that minimum is.
Good to know. Next question is about the debt statement and wondering if it needs to include the credit card balances or just loans.
And the answer with that, so when I mentioned the business debt schedule, that's just business debts. You'll have a business debt schedule, which includes just business debts, and then you have your separate personal financial statement that covers you as the owner of the business. On the business debt schedule, yes, you would include all debt owed by the company. That would include your credit cards, your business credit cards, or anything that the company's liable to repay. And then on your personal financial statement, you would list your loans and your credit cards, your personal loans and credit cards on that statement.
Good to know. Okay. Question on microloans. If there is no microlender in your area, can you use a microlender from another area?
And unfortunately, the answer is no. So when you get the slide deck, you will click on that link and you will see each lender, at least in Virginia, and what area they cover, and they are not permitted to lend outside their approved territory. I mean, I can tell you there is one lender on that list that is permitted to lend statewide. They used to be called Axion. They're now called Ascendus. But I have to be honest with you, they are not doing a lot of lending in our state. So you can check with them and see if they would be willing to lend to you in Virginia. But we're not seeing a lot of loans. That's the only statewide microlender. All the other microlenders we have specific territories. And no, you cannot. Okay, let me say one other thing. So you can't get an SBA microloan if your business is not located in that lender's territory. But some of these lenders have separate lending programs that are not SBA lending programs. So you can ask them about that and see if they have a non-SBA option. But in terms of SBA microloans, they can only approve loans in their territory.
Noted. All right, so the next question is about SBA 7A loans. How long does it take to get them approved or receive approval? Are those funds received lump sum or paid to vendors as installments? And at what point in the process does repayment begin? Is there a grace period before the monthly installment?
Okay, so I'm going to copy that because I knew you were going to get rid of that off the screen, Ellie, and I wanted to look at it. So I just copied it to my text pad here because I want to make sure I answer all three questions. So the first one there, how do I get rid of the screen? Okay. So how long does it take to approve the loan? So again, you heard me mention earlier that a lot of the delay is the back and forth between the business and the lender. So that, just keep on top of that and give the information to the lender that they ask for. So some of our loans, especially our smaller loans, you can get a turnaround in, a week or less. Now that's SBA's turnaround, not the lender turnaround. And then some of the larger loans, you're probably looking at least 2 weeks. For a 504 loan, you potentially it might be even longer than that, maybe 3 weeks to a month. So it'll depend on the request and then the back and forth between the lender. In terms of the lump sum versus paid to the vendor, so if you're getting a term loan, we do allow the lender to have multiple disbursements of the funds, so they can they don't have to disperse that all as one lump sum. They can disperse that as you need it. We do require them on a term loan to fully disperse the loan within 48 months, but they can have multiple disbursements. You can talk to the lender about that. And then in terms of repayment, so we've talked about two types of financing options: term loans and lines of credit. So with term loans, repayment, well, actually, with both of them, the lender can offer an interest-only period. So we see this frequently. Sorry, my phone is going off. We see this frequently with startups. The lender will potentially give you a 3-month interest-only period or a 6-month interest-only period. So you would only be paying interest in that time period. They won't give you most of them will not give you a full deferral, so that it would be, no payment at all. So they would have that interest-only period, and then you would start your principal and interest payments after that. You can talk to the lender about that. And lines of credit, a line of credit is set up generally to be interest only. That's where you can draw on it and pay it back as needed. So that's generally an interest only structure anyway, and that would begin immediately. So the interest only period is going to begin immediately. If there is no interest only period, then you would just start paying within a month after the loan closes. You would start making your payments.
Good to know. So next question is if you could touch briefly, since I know we only have about 14 minutes left, if you could touch briefly on surety bond loans for government construction RFPs or government contracting in general.
Okay, so those are not loans, they're bonding. We do have what is called a surety bond guarantee program, and it works similar to what I've outlined on the 7A program. So we work with surety companies under that program. They actually provide the bonding to the company, and then if there's a problem, SBA will step in and reimburse that surety company for a portion of their loss. So it's similar to what I've outlined again on the 7A side. I can put a link in the chat about that program. And you would, just like I've mentioned on the lending programs, you go directly to the lender on our lending programs. With the surety bond guarantee program, you would contact a surety company, one of the surety companies that are listed on our website. You would go to them, explain what is needed, and then they would talk to you about the requirements and the cost of that, et cetera. So let me do that. Let me get my link here and I'll put it in the.
Thank you. Are you good for me to ask the next question while you do
Sure.
that?
Yeah.
All right. So I have a few of similar questions. Can you use SBA loans to start up a barbershop or a laundromat service or a flower shop?
Yes, all of those are eligible types of businesses.
And what sort of loan would you recommend they apply for?
Well, so okay. First of all, I told you I didn't want to overwhelm you with details. I may have done that already, but my suggestion would be find an SBA lender, and like I said, you can use our list or you could use the lender match, and then the loan program they use will uh, be determined by what you're asking for. You know, are you gonna buy real estate? Are you going to do you just need a line of credit? And that will help narrow down for the lender which program to use. So it really depends on the loan amount, what you're going to use the money for. It's not really tied to the business, the type of business itself. It's more tied to your loan amount and what you're going to use the money for. But the lender can talk to you about that. Now, I will say, you heard me say, if you're buying real estate or constructing a building, you may want to first look at the 504 program. And then if that doesn't work out, you could look at the 7A program because the 504 program has many benefits for the small business if you're buying real estate or constructing real estate.
Related to that, constructing real estate or buying real estate point, we have a question about your thoughts on using a broker versus to get a loan versus going to the SBA for a new construction of small homes, not tiny homes, just small homes.
Okay, so using a broker, that's really your decision. Now, I will tell you that you heard me talk about owner occupied. We only lend for owner occupied real estate. We do have one program that does allow spec building, either residential or commercial, but I just have to be upfront. We see very little activity in that. In fact, we've probably only had one loan here in our district under that program in the last 20 years, 20 plus years. So it's not really, I don't think you'll find it useful. So generally, if you're building homes, you would not be eligible. Well, if you're building under contract, potentially you could get an SBA loan, but not if you're a spec builder, spec home builder. So, and then in terms of the broker, that's your choice. I mean, many lenders have relationships with brokers and they find them useful, but that's really your choice, whether you use a broker or not.
All right.
Allie, how do I put this link? Where do I put this link that I want to?
Yeah, if you go to our chat, just as a note, the chat function is disabled for participants, but we are able to send things to attendees and participants. So if you go to the chat function, you should be able to select everyone and send things there.
Yeah, I see. It says host and panelists.
If you'll send it to me, I can send it to everyone.
Okay, that's for the surety bond guarantee program.
Give me 1 second. While that is going through, our next question is, can you use SBA loans for new technology, specifically looking into alternative sources of fuel for transportation?
New technology is not prohibited in any way. What I will mention related to that is if you're in the R&D stage, you cannot use SBA loan programs for R&D. But if you are, you have your product and you're ready to begin selling it, I don't see any reason why that would not be eligible. I mean, the most important thing the lender wants to see is that you're either currently operating or, you're ready to hit the ground running. If you're a startup and you have your plan, you have your product ready to sell. Uh, I don't know specifically what the technology is, but and that also will depend on the lender. So some lenders are more comfortable with that sort of thing. Some lenders are not. So we don't have any prohibition on that. As far as I can tell, it would be eligible.
Wonderful. Next question is, can you secure an SBA loan if you have limited personal income after leaving a W-9 job to start a small business?
So the main thing there that I see is related to the equity injection. So if you have limited income, I mentioned that with startups, generally lenders want to see some sort of cash injection. I mentioned that we set a 10% minimum, so I would at least, look at trying to build up that amount. That's probably the main limitation. I mean, the repayment of the loan is going to come from the business, not from you personally, unless there's a default. So the lender's going to is going to look at the business financial projections when they make their decision in terms of the loan. So your personal income mainly will come into play related to the equity injection. So you should probably, I mean, they're going to ask you for some sort of equity injection, and we generally don't like to see borrowed equity. So you may want to work on building up some equity before you apply for the loan. But the lender can tell you what their criteria are, each lender. And I see one here, Allie, I do want to talk about. I almost mentioned it a second ago, and then I forgot. So I talked about the non-SBA fee. If a lender charges you a non-SBA fee and how that has to be reported. But there is, with all of our lending, 7A and 504, there are fees. Now on the 504 side, excuse me, there are SBA fees. So this question is specifically about SBA fees. So on the 504 side, those fees are rolled into the loan amount. So you don't pay those generally out of pocket. There may be an application fee, but the ongoing fees are paid in your loan payment. And then on the 7A side, there is an SBA guarantee, what they call a guarantee fee. It's an upfront fee that the business will be required to pay. Now, many lenders will also be willing to finance that on the 7A side, so you can ask them if they're willing to finance that in the loan. But there is a guarantee fee on the 7A side, and you'll see that on your loan chart when I send it to you. It'll outline what that fee will be based on the loan amount.
Wonderful, thank you. Next question we have is, can equipment purchased with the loan be used as collateral? In that case, would it be better to purchase all the equipment new, or would it be better to purchase used equipment that has a higher value than your purchase price?
So anything purchased with the loan, equipment, a building, all of that, SBA requires that the lender take that as collateral. So that will be required as collateral. And then in terms of whether you buy new or used, that's really your choice. I mean, let's say you go to the lender and you say you're going to buy used equipment, but it only has a useful life of a couple of years. Well, the lender's going to ask you, well, what happens in 2 years when the when the equipment potentially fails? So, I mean, it's your business decision in terms of whether you buy new or used. Obviously, if you can get a decent, good quality used piece of equipment, you may not need the new fancy, the new equipment. So it's really your choice on that. And yeah.
On a related note for collateral, we have a question about if someone is willing to let another person use their home as collateral. Sorry, let me start that one over. If the person doesn't own a home to use as collateral, can they, with permission, use someone else's home as collateral?
Well, definitely I mean, the lender doesn't really care so much where the collateral comes from. So that would lend strength to your request. If you have someone else, let's say it's a parent, or I don't know, a sibling or something that's willing to pledge their home, that would definitely help in terms of the potential for approval of that request. The more collateral, the better. So I don't see any downside to that.
Good to know. Um, Related to the earlier questions about childcare, care of people, can an SBA loan support home health care services?
Yes, yes. So we've made many SBA loans have been made many times to home health care business. I mean, that's when I hear that, that's where the business sends people into the home. I mean, my understanding to provide health care. That's eligible. Yes.
All right. Um, will using home equity be viewed as a negative form of equity?
Okay, I'm glad someone asked that question because there is a difference between equity, well, cash. Okay, there is a difference between a cash equity injection, what they call a cash equity injection. That's cash that is put into either the startup of the business or the financing package that you're looking for. That's cash, and that is different from collateral. So that comes up frequently. If you have equity in your home, okay, let's say you're a startup and the lender says, I need 10% cash. If you tell the lender, well, I own a home and I have, let's say 25% equity, 30% equity in that, I'm going to use that as my cash equity injection, that will not work. That equity in your home is considered collateral coverage, not a cash injection. So the only way that that would become a cash injection is if you maybe got a HELOC or something and pulled that equity out into cash and injected that into the financing package that you're looking for. But again, at least on the 7A side, we don't like to see borrowed equity. There are some cases where it's allowed. On the 504 side, you can do that. But again, there's a difference between collateral and a cash equity injection. They're not the same. They're not the same thing.
So it does look like we have reached our end point since it is 1:30. I'd like to thank you, Ford, so much for these wonderful answers and excellent information in your presentation. As a reminder to all of our participants, a recording of today's session and the slides will be shared as part of a follow-up email that will be sent to everyone within a week of this webinar. And if we weren't able to respond to your question during our Q&A session, please feel free to send us an appointment request through our website or my email, and we'll be sure to help connect you with resources that can support your business needs. Thank you everyone for joining us today, and we hope to see you all in future webinars.